Retail traders map their charts with standard structural levels, order blocks, and fair value gaps. But these zones are frequently engineered to act as liquidity traps, swallowing retail stop losses to fill massive institutional orders. When price reaches these macro points of interest, candlestick shapes and standard price action deceive. A bullish pin bar at a support level is often a manufactured lure rather than a genuine shift in momentum. The problem compounds in decentralized markets like Forex and crypto. Because there is no central exchange clearing every trade, the true centralized volume data is entirely hidden from the retail public. To solve this, quantitative traders use tick volume. Instead of measuring the exact dollar amount traded, tick volume measures the frequency of price updates. This frequency acts as a highly accurate correlated proxy for institutional transactional density. Relying strictly on price action without a volume proxy ensures you are executing your trades blindly against engineered institutional traps. To survive, you have to measure the mass behind the movement. This brings us to volume spread analysis, or VSA, developed by Tom Williams. It is a mathematical framework that filters out market noise by pairing the range of price movement with transactional frequency. We isolate a single candlestick to define our first variable, spread. Spread is the total distance from the absolute high of the wick to the absolute low. Our second variable is volume. We categorize this frequency into tiers from low to ultra-high. The core of the VSA framework requires spotting volumetric anomalies. You are specifically looking for the exact moments where wide-range candles pair with ultra-high volume. By combining the spread of the candle with tick volume, you shift your entire approach. Instead, you stop trying to predict where the market might go and start reacting to verifiable institutional footprints. Isolated volumetric anomalies mean nothing on their own. They are useless without the correct macroeconomic context dictating the background trend. This chart shows how to identify a macro point of interest. We locate a structural imbalance, like a 1-hour fair value gap, before zooming into the granular 5-minute price action developing entirely inside that boundary. You must wait for the price to physically tap the macro level. Only then do you execute your VSA entry models on the micro timeframe. Inside that zone, your objective is strictly defined. If the macro trend is bullish, look for a sign of strength. If the macro trend is bearish, look for a sign of weakness. The macro structure dictates the location of the trade. The micro VSA dictates the exact timing of institutional delivery. The highest probability entry model within this framework is the climactic action bar, or CAB. This chart sequence visualizes the 4 mandatory conditions of a CAB. You need a preceding climax of declining candles, a directional down candle, a wide spread from high to low, and a corresponding dramatic spike of ultra-high volume underneath. This specific bar is an anomaly. It signifies an extreme influx of institutional capital stepping in to absorb retail panic selling at a key structural level. However, you never execute a trade on the climactic action bar itself. The anomaly tells you smart money is active, but you still require structural resolution to confirm their intent. To find that resolution, we draw vector lines precisely across the absolute upper and lower wicks of the CAB. These are your trigger lines. By bracketing the CAB, you trap the volatility. You force the market to resolve the anomaly and reveal its true directional bias before you commit a single dollar. Once bracketed, the CAB resolves in one of 3 ways. In scenario 1, the median probability setup, subsequent price action briefly sweeps the liquidity below the lower trigger line before reversing to break the upper trigger line. In scenario 2, the price immediately breaks the upper trigger line without ever sweeping the low. This immediate breakout is trend-dependent. It's only mathematically viable if the macro trend is hyper-aggressive or if the initial CAB already features an exceptionally long lower wick that did the sweeping for you. Scenario 3 is the high-conviction setup, offering incredibly high win rates. Here, price intentionally prints a full-body close completely below the lower trigger line, consolidates, and then violently surges back above the upper limit. The psychology behind this is highly engineered. The physical breakdown below the trigger line convinces retail traders that the floor has collapsed. They aggressively short the market, generating the exact liquidity institutions need to absorb in order to reverse the market upward. The most profitable VSA entries actively require retail traders to be trapped on the wrong side of the trigger line. The climactic action bar is not the only volumetric anomaly. The two-bar reversal proves that standard candlestick analysis severely misinterprets the classic engulfing pattern. This diagram shows a standard engulfing setup. In traditional price action, a large green candle swallowing a red one is a buy signal. But mathematically perfect engulfing shapes routinely fail at order blocks because they ignore underlying volume divergence. To validate the pattern, we apply two-bar reversal scenario 1. You need a high-volume down candle that is completely engulfed by an up candle, printing distinctly low volume. The logic is highly counterintuitive. Low volume on an upward engulfing candle proves supply exhaustion. It means the selling pressure has completely evaporated, allowing price to advance upward with zero institutional resistance. Scenario 2 alters the equation. Here, the green engulfing up candle sweeps the local liquidity below the previous down candle's low. In this specific case, high volume on the upward engulf is completely acceptable. The volume spike isn't selling pressure. It reflects the institutional absorption of retail stop losses triggered by the sweep. Without volumetric confirmation of either supply exhaustion or liquidity absorption, an engulfing pattern is just a random shape drawn on a chart. This final chart overlay maps the complete sequence. Executing VSA requires layering timeframe alignment, volumetric anomalies, and strict trigger rules into a single protocol. You wait for the micro timeframe to tap the macro level. You identify the ultra-high volume spike or the engulfing divergence. You bracket the extremes. And you wait for structural resolution to break your trigger line. Risk management is absolutely non-negotiable in this system. Your stop loss is placed strictly beneath the absolute lowest extreme of the volumetric anomaly. For take profits, you scale out at the origin point of the preceding structural breakdown. That origin level acts as the first line of institutional defense, and price will react there. Enforcing these rules strips away emotion. You transition your trading from a predictive guessing game into a reactive, quantitative system built entirely on proof of delivery. Price action can paint false breakouts. Support levels are engineered to fail. Momentum indicators will always lag. But the single true element that institutions cannot hide is the sheer mass of their capital entering the market. They cannot move millions of dollars without leaving a footprint in the volume histogram. Stop trading the illusion of shape and start trading the reality of volume. Your edge in the market relies on waiting for the unforgeable signature of smart money and letting their capital do the heavy lifting for you.